Meanwhile, when we speak of investments, how can talk of taxes be left behind? Jaideep, I'll bring you in. Could you throw some light on the tax implications of passive funds and the different kinds of passive investing strategies that you could advise?
It's actually, just echoing some of the sentiments of my fellow panelists first. I think it's an exciting time to be an investor. And there is obviously a danger of going over the edge in trying to outsmart the market. But yeah, I mean, I certainly trust the experts and not try and do too much myself. I mean, coming to the taxation question, Gautam, the reality is that, you kind of really saving on two things. I think one, also the transaction tax, right? So there is lesser incentive for the passive fund manager to keep churning the portfolio, and it's a kind of almost not inherent in the strategy relative to an active one. So there's that kind of potential saving that you can look at. And I think the other part is also in terms of the underlying portfolio. You can save in terms of actual capital gains, because again, if buying and selling is less, and there's therefore less actual realization of capital gains and more, let's say, unbooked capital gains, especially in the bull markets that we've seen in the past, past few months, past few quarters, then you can actually just sit on your cash, let it ride for longer, and take advantage of the long-term capital gains rather than get it by short-term capital gains, for example, and then indexation and all the rest of it. So those are the two things that come to mind, where inherently, or as a model, passives would be kind of superior in terms of tax performance. And then over a period of time, of course, this then acts as a little bit of a booster to your search for alpha, right? Because all of these savings, someone talked about the front loading of costs and so on. But if you're holding them for longer, then these savings also ultimately add up to your returns here.
All right. Abhishek, anything to add to that?
Yeah, so I think from a taxation standpoint, I think passives offer you pretty similar taxation with the added benefit of savings that Jaideep was talking about. The fact that they empower you in terms of taking control of your portfolio, just like Kanika was talking about small cases. One needs to be just careful about not playing with it too much, because while you are booking profits, while you are buying the dip and trying to take advantage that it's gone up, it's gone down 2%, I bought it, let me just quickly book profits on 5% and get back in again. Every time you do this trade, you're actually accumulating a tax cost. And what passive fund help you do is that they automatically, as Kanika had also referred to, rule-based investing. So indexes are designed to actually churn themselves and save on that churn cost for you. One just needs to bring in a little bit of more discipline, while they are pretty much the same as your normal mutual funds. Anything more than 65% in domestic equities gives you equity taxation. Everything else is debt taxation. But at the end of the day, the more transactions you turn in your portfolio, the higher your potential tax cost could be. So one just needs to be careful about that discipline and about the fact that you're managing your asset allocation right. If your asset allocation is going, sort of awry because of market having even maybe gone up too much or gone down too much, taking that cost of tax could actually be a small sacrifice for a bigger goal at the end.
All right. I also want to get your thoughts on this. Well, you could call it criticism by some global investors that, index funds, ETFs, they're all skewing towards bigger companies, and in a sense, smaller value stocks are being neglected. Any thoughts on that, Abhishek, Kaustubh, Kanika, that you would want to respond when you hear that viewpoint being shared across?
Personally, I think to some extent this criticism has been earned. It's right also that, the way traditional indexes are designed, there is larger contribution of the biggest companies in the portfolio. But at the same time, there are these different genre of funds which are coming in, different index and rules which are coming in, which are called smart beta. And I think that's the next step, which is going to be driving the growth for the passive industry. You have equal weight as a strategy which has come out this year. And over the last many years of research, it has shown that it actually generates some bit of alpha over the traditional indexes. While it does, traditional indexes do have their own issues with respect to what you mentioned about larger company bias. It also ensures that smaller companies or the wisdom of the market is actually built in. The smaller companies or companies which are not performing are weeded out over a period of time. And I think maybe Kaustav and Kanika can opine on this in a more evolved manner, looking at how it's happened for international and how it's catching up in India.
All right, Kanika, your response, and then we'll come to Kaustav.
Yeah, no. This, I think it's very fair to say that when you're buying even the S&P 500, there is a unfair weight to FANG, etc. that ends up happening. So two things, at least in India, I think we have a lot to do to increase depth of market. A lot of that comes through, more trades or more liquidity that needs to come in. I'm just going to throw this out there. We need to reduce transaction costs on a lot of things that we have, right? A bunch of the STT stuff comes down. There's more liquidity in the market because more trades are happening. That is one part of it, which is increasingly markets need to be deeper. But having said that, as soon as you start to get thematics, there will be lots of pockets of very interesting kind of ETFs you can buy. So for us, for example, in the US, you can buy a PET CTF. Right? We personally own a lithium ETF instead of an EV one. There are so many different ways to play it where there are small amounts that go into different pockets, which is where this whole level 2 or more discerning investor who's going to try and figure out themes comes in. But the criticism of indices is absolutely right. And there is a little bit of indexes are broken in many ways, and that sort of translates into the ETF industry. So we need to fix that at a structural level before we address that at an ETF level.
Right, Kaustav?
Yeah. So I think Abhishek and Kanika really hit the nail on the head that yes, and this push and pull that's been happening, especially with when you look at the international context where ETF flows or passive flows have really dwarfed the active flows over the last decade, especially in the US. It has kind of led to more money chasing those larger capitalization companies given the construct of the indices. So I would say that criticism to a certain extent is it's definitely fair. But when you think about it, right, that what that also allows then, you think about market forces at play, like Kanika was talking about, that you can also then delve into more thematic ETFs. Active managers can start taking bets, and that's kind of the market dynamics at play, where you will always have elements where investors will be looking at, okay, maybe your traditional passives are not that great. I want to look in equal weight, or I want to look at a value or a dividend yield, or something like that in terms of thematic play. So I think that's the push and pull, which is really a part of parcel of the market. But yes, I think to a certain extent, given how the the index creation in terms of really that top heaviness, which is not just in India but a lot of other international markets, is going to continue. But I think the good part is at least we've seen a healthy pipeline of newer companies getting listed. So hopefully we'll get a more broader, deeper market, in the years to come. But yeah, I think that's I would say fair criticism to start with.
Yeah.
All right. Before we come, sure. Go ahead.
I'm also worried what happens when ETFs get too big, right? And they're essentially now how much of price action is artificial because ETFs need to be buying versus a stock being fairly valued. So because markets are so self-correcting, I can see them fixing themselves over long periods of time. But I am worried that why is the price of the stock X? Is it because too many ETFs bought it, or is it because that's what the market thinks it is? So it's almost ironic that ETFs can bring a certain level of inefficiency to the market also.
An investor education and awareness initiative of Aditya Birla Sun Life Mutual Fund. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.